Ever wondered what happens when you invest $100,000 in QQQ? Welcome to our exploration of the world of exchange-traded funds, or ETFs. In this video, we're focusing on a particularly popular one, QQQ. Now, you might be asking yourself, what on earth is QQQ? Well, it's an ETF that closely tracks the NASDAQ 100 index, which includes 100 of the largest domestic and international non-financial companies listed on the NASDAQ stock market. So if you've got a cool 100 grand burning a hole in your pocket and you're considering investing it in QQQ, you're in the right place. We're going to dissect what exactly happens when you make such an investment. We'll delve into the ins and outs, discussing potential outcomes, risks, and rewards. So buckle up, because we're about to embark on a financial journey. Stick with us, and we'll dive deep into the process of investing in QQQ. Before we dive into the specifics, it's important to understand what QQQ is. At its core, QQQ is an exchange-traded fund, commonly known as an ETF. But it's not just any ETF. QQQ is one of the most widely traded and recognized ETFs in the world. QQQ, also known as the PowerShares QQQ Trust, was launched back in the year 1999. It was designed to give investors a way to gain broad exposure to the tech sector, which was rapidly growing at the time. But QQQ isn't solely focused on tech stocks. It's actually based on the NASDAQ 100 index, which includes 100 of the largest domestic and international non-financial companies listed on the NASDAQ stock market. The NASDAQ 100 index is heavily influenced by companies in the tech sector, but it also includes companies from various other sectors. These sectors include healthcare, consumer services, and industrials, to name just a few. This gives QQQ a more diverse exposure than a purely tech-focused ETF. So why might investors choose to invest in QQQ? There are a few key reasons. First, QQQ provides instant diversification. Instead of picking and choosing individual stocks, investors can buy shares of QQQ and gain exposure to a wide range of companies in one fell swoop. Second, QQQ's focus on the NASDAQ 100 means it tends to lean towards growth-oriented companies. This can be appealing to investors looking for potential growth in their portfolio. Finally, as a passively managed ETF, QQQ has lower fees compared to many actively managed funds. Now that you have a basic understanding of QQQ, let's move on to how you can invest in it. And remember, feel free to share your experiences with ETFs in the comments below. Investing in QQQ is a relatively straightforward process. It's quite similar to buying a share of stock, with a few extra steps involved. First things first, you'll need a brokerage account. This is an account through which you can buy and sell stocks, bonds, ETFs, and other types of investment products. There are many online brokerages to choose from, each with its own set of features and fees. You'll want to pick one that suits your needs and budget. Once you have your brokerage account set up, the next step is to do your homework on QQQ, or the Invesco QQQ Trust. Tracks the NASDAQ 100 index, which includes 100 of the largest domestic and international non-financial companies listed on the NASDAQ stock market. It's a great way to get broad exposure to tech and growth stocks. Through your brokerage, you can access plenty of research materials and data about QQQ, including its historical performance, expense ratio, and holdings. Next, you'll want to decide how much to invest. This will depend on your financial situation, risk tolerance, and investment goals. Remember, investing always comes with risks, and you should only invest money you can afford to lose. It's also a good idea to diversify your investments to spread the risk. Now you're ready to make your purchase. From your brokerage account, you'll navigate to the trading platform. Enter the ticker symbol QQQ, specify the number of shares you want to buy, and then click Buy. You'll want to double-check all the details before confirming the transaction. Congratulations! You've just invested in QQQ. It's important to note that investing is not a one-time event, but a process. You'll want to periodically review your investment, adjusting your strategy as necessary based on market conditions and your financial goals. And there you have it. You've just invested in QQQ, but what does this mean for your $100,000 investment? Don't forget to subscribe to stay informed. So, you've invested $100,000 in QQQ. What happens now? Well, let's take a walk down the investment lane. The first thing to understand is that QQQ tracks the NASDAQ 100 index, which includes 100 of the largest domestic and international non-financial companies listed on the NASDAQ stock market. This means your $100,000 is spread across these top-performing companies. Over time, your investment in QQQ can grow, and this growth is primarily due to two factors: capital gains and dividends. Let's break that down. Capital gains are the increase in the value of the ETF's shares. For example, if the NASDAQ 100 index goes up, the value of your QQQ shares will likely follow suit. Dividends, on the other hand, are a portion of the profits that the underlying companies in the index share with their stockholders. Many of the companies in the NASDAQ 100 index do pay dividends, and as a QQQ shareholder, you would be entitled to your share of these payouts. Now, it's important to remember that the stock market is a dynamic beast. It can roar one day and whimper the next. This is what we call market volatility. Your QQQ investment will be affected by this volatility. There will be good days when the value of your investment goes up, and there will be challenging days when it might dip. Looking at historical data, the QQQ has shown solid performance over the years. In fact, over the past 20 years, it has significantly outperformed many other index funds. But remember, past performance is not a guarantee of future results. So, the bottom line, your $100,000 invested in QQQ has the potential to grow substantially over the long run. But like all investments, it's not without risk. The key is to stay informed, stay patient, and stay the course. Investing in QQQ, like any investment, comes with risks and rewards. What are your thoughts? Drop a comment below. Let's recap what we've discussed today. We started off by defining QQQ. It's an exchange-traded fund that tracks the NASDAQ 100 index. This index includes 100 of the largest domestic and international non-financial companies listed on the NASDAQ stock based on market capitalization. So when you're investing in QQQ, you're essentially investing in these top companies. We then moved on to talk about how to invest in QQQ. The process is quite straightforward. You'll need a brokerage account first. Once that's set up, you can buy and sell QQQ just like any other stock. You can buy it during market hours, and the price will fluctuate throughout the day. But what happens to your investment? Well, that depends on a variety of factors, including the performance of the companies in the NASDAQ 100 index. If these companies do well, your investment in QQQ will likely grow. But if they don't, your investment could decrease in value. Additionally, QQQ pays out dividends, which can be reinvested to buy more shares or taken as cash. It's important to remember that investing in QQQ, like any investment, comes with risks. The value of your investment can go up or down. It's also worth noting that while QQQ includes some of the biggest and most successful companies, it's heavily weighted towards the technology sector. This could be both a strength and a weakness, depending on how tech companies perform. In conclusion, investing $100,000 in QQQ gives you a stake in some of the largest and most influential companies in the world. It's a simple way to gain broad exposure to the tech industry and other sectors. But as with any investment, it's crucial to do your research and understand what you're getting into. Remember, investing is a journey, and the more you know, the better your decisions will be. Thanks for watching, and don't forget to subscribe for more informative videos like this one.